Greetings to my fellow friend and professor. This video about our presentation for a newly standard IFRS 16 lease. First off, I will present about the first part of this IFRS 16, which is objective. The objective of IFRS 16 is to specify the principle of recognition, measurement, presentation, and disclosure of lease. Next, the definition. The definition is process whereby the owner, the lessor of a particular asset enters into an agreement, the lease, with the user, the lessee, for the latter to use the asset for a specified period of time. Next, we look at the scope. Let me show you all a few scope exception. So the IFRS 16 does not apply to various type of arrangement as I stated below, which is leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources, leases for biological asset held by a lessee. Next, rights held by a lessee under licensing agreement for items such as films, videos, plays, manuscripts, patents, and copyright. In addition, leases of biological asset held by a lessee, and last but not least, license of intellectual property granted by a lessor. Also, there are two recognition exemption. They relate to these two types of leases. Leases with the lease terms of 12 months or less with no purchase option. These lease apply for all asset like motor vehicle and leased below 1 year. Also, you cannot apply IFRS 16 to one vehicle and not applied for another vehicle. And the second recognition is leases which the asset has low value when new, such as personal computer. Hence, I think it's good to have this exemption because that will make accountants' life easier. You will account the lease payment in P&L account on the straight line basis or some other basis. And now let's we look at the process of lease. As I mentioned earlier, lease is a process where the lessor of a particular asset enter into an agreement or the lease with lessee for the latter to use the asset for a specified period of the time. Well, if it is carry the right to control to use of an identified asset for a specified period of time in exchange of consideration.
Hi, my name is Tulash, and today I'll be explaining about recognition of lessee. Recognition of lessee has the right to use asset and liability in their balance sheet. Lessee is the one getting the asset to be used on lessor. There are two types of recognition, which is right of use asset and lease liability. So before I explain that, let me tell you what is initial measurement. So initial measurement is meaning the first day of the contract and how much it should be recorded on the balance sheet. So let's look into right of use. Initial measurement, the cost of the right of use should be equal to all four of these, as you can see, which is the amount of measurement of lease, payment made before or made on the commencement date, initial direct cost incurred by the lease. So example of initial direct cost is legal fee, commission, except for marketing costs. And lastly is estimate of cost to be incurred by the lessee is demanding and removing the underlying asset. So now moving on to lease liability. Lease liability is initially inception and must be recognized under liability. It is measured at the present value of the future lease payment where interest will be occurred. The payment includes all 5 of these as well, which is fixed payment, less any lease incentive receivable, variable lease payment, amount expected to be payable under residual value guarantees, exercise based off a purchase option if the lease is reasonably certain to be exercised, payment and penalties to be terminating the lease. Okay, so now I'll be explaining about subsequent measurement for both right of use asset and lease liability. So before that, let's look into the meaning of subsequent measurement, which is end of the year, end of the first year period, second year, third year, and so on. So now let's look into right of use asset. In this, we use cost model, whereby we minus cost with accumulated depreciation, followed by impairment if we need it. And next, we adjust for any remeasurement of lease liability. So moving on to lease liability, whereby we reduce the liability while making the payment, whereby we increase the carrying amount to reflect the lease liability, whereby we also pay interest for it. And next is reduce the carrying amount for lease payment. And lastly, we don't really need modification, but when there is a modification, we should remeasure it and adjust it back. And about this will be further explained on the next slide. Thank you.
I'm Kumala. So now I will present about the measurement for initial payment and also subsequent payment. Okay, for initial payment, we will first calculate the lease liability before right of use asset. This is because the amount of lease liability, we will use it to calculate the right of use asset. Okay, so lease liability is the present value of future lease payment. Okay, these are the future lease payment, and these payments are not paid at the commencement date of the lease. These are all in the future that the lessee will pay, which is fixed payments, variable payments, residual value guarantees, penalty payments, purchase option price, less incentive received. But we cannot simply take the amount and add all here. We have to discount the future values to present value by using interest rate implicit. And this is where we have to use the present value and future value tables. So we'll see about the table in a while. So after we calculate all these amounts to present value, then we can add up and then we can get the lease liability. So after we get this, we can now calculate the right of use asset. Okay, so the amount of lease liability should be added with the lease payment before or on commencement date, which means the deposits, plus any initial direct cost, plus estimated dismantling costs and less incentives. So now let's see the present and future value table. So this is the present value table, and we have to use this table when the amount of payments are not the same every year. Okay, if let's say for example we are going to pay 2000 in 2023, which means in the second year, right? So if let's say the percentage, the interest rate is 7%, then we just go to the second year and 7%, which is 0.8734. So we times this with 2000, and the present value of the 2000 is 1747. So this is how we should use this table to calculate the present value of the future payments. Okay, this is the present value annuity table. Okay, we have to use this table to calculate once if the payments are the same every year. So for example, if I'm paying 2000 for 2 years, which means 2000 in the first year and 2000 in the second year, that means 4000, right? So the 4000 is the future payment. If I want to find the present value of the 4000, then I have to use this table, because the payments are the same amount. So if let's say the interest rate is 7,000 and the period is 2 years, right? So 1.8080. We have to do 2,000 times 1.8080. So the present value of the 4,000 is 3,616. Okay, we can also use the previous table to calculate this, but we have to calculate it one by one. We have to first calculate the present value of the 2,000 in the first year and 2,000 in the second year, then add that two to get the present value of 4,000. If we use this table, we just calculate it once and we get the present value of the 4,000. So now let's see the measurement for subsequent payment. For right of use asset, we should calculate the depreciation. And for this, we can use cost model, fair value model, or revaluation model. It just depends on what is applied for the PPE. Here we used cost model. And for the depreciation, the formula is cost minus guaranteed value over lease life. So cost here is the amount of right of use asset that we have already calculated in the initial measurement. Okay, that is cost minus guaranteed value over lease life. Lease life is the lease term. If let's say the lease is for 3 years, and then this is 3. Okay, so for lease liability, that debit is interest, credit is lease liability, right? So the formula of interest is interest rate times lease liability, and this interest should be amortized. So for the first year of calculating interest, we should use the amount of lease liability that we have already calculated in the initial measurement. After the first year, we have to use the balance lease liability that we have. So after we made the payment, to reduce the lease liability, we have to debit lease liability and credit cash or bank.
Assalamualaikum and hello everyone. My name is Vicky. So today I would like to share with you guys the example that I took from the CPA textbook. This example is related to accounting by lessee. So let's take a look. So on 30 June 2000 X4, LA Limited lessor leads a motor to B. So we can see that there is lessor and lessee there. And at that date, the fair value of vehicle is $68,000. Its estimated residual value at the end of the lease term is $10,000, and its economic useful life is 6 years. The agreement cost A Limited is $2,647 to set up and include the following details. So we can see those details. Annual lease payment, it need to be paid in advance every 30 June. So it costs 19,800. Executive costs, it's already included in this 19,800. So the executive cost is 1,800. Residual value guaranteed 6,000, unguaranteed residual value 4,000. This term 4 years, and also interest charge for the lease is 9%. So what other information that we can take out from the statement? So basically we just take out everything here, so we can see what is related here. So we can see, first of all, the residual value at the end of the lease term, 10,000. So residual value here is actually divided into two, which is residual value guaranteed and unguaranteed residual value. So we have 6,000 and 4,000. So 6 plus 4 is 10,000. Okay. So basically, residual value here means the estimate fair value of lease asset at the end of the lease term. So at the end of the lease term, there will be some estimate value that need to be charged. Okay. So and usually residual value guarantee will be included in the minimum lease payment. So we need to know what is the lease payment. In order to know that, we need to see here. It mentioned that it has 19,800 for annual lease payment, but it is include the executory cost, so we need to minus. Okay, why we need to minus, we need to exclude the executory cost, because executory cost is not related to the leases. So executory cost is actually the cost that used to repay or cover back the other expenses that paid by the lessor. Why it is not related with the leases is because executory cost is a different things. It's actually costs like maintenance, maybe insurance, and also tax property. So it's actually a different things, so it need to treat differently. So next, so first of all we need to find the value right of use, ROU. So ROU here is equal to lease liability plus lease payment that made at the beginning. So at the beginning we paid 18,000. Why we pay 18,000? We already exclude here, it already mentioned. So we need to minus, and now we need to pay 18,000 in advance. Okay, since it said in advance, you need to pay first in year 0. Okay, and then after that you need to pay in year 1 for if you want to continue the leases. Okay, and then so basically lease payment that made at the beginning is 18,000. We already found it, but lease liability is a different thing, and we need to find this lease liability. Okay, so these are the remaining years that not paid. So lease liability equals to PV, present value of future lease payment. It's include guaranteed residual value, which is 6,000. Okay, so 6,000 need to be paid at the end of the term. So we have 9% at over 3 years. Okay, so first we need to calculate the value, the present value of 18,000 in the future. So how to know that? We need to take the 18,000, and we know that we pay 18,000 for 3 years. The liability we need to pay 3 times. Okay, so we need to use PVIFA because it is in a series of payments. So we need to use this one. We can see here 9% for the interest, and also the period is for 3 terms, 3 years. So we have 2.5313, and we need to times with 18,000. We will get 45,563. Next, we need to use PVIF table, or just use this formula also can. At the for the 4th period. Okay. Why 4th period? Because of this, we pay this at the end of this year. The residual value is the amount that estimate of the value at the end of the lease term. So at the end of 4 years, 6,000 is actually equals to 4,250 today. So basically it is decreasing. Same goes to unguaranteed residual value, which is 4,000. 4,000 in the future will not be the same. So 4,000 in the future, in the 4 years, at the end of the 4 years, will be 2,834. So let's move on to the next slide. We need to total up in order to find ROU. So we know the lease liability equals to advance payment for remaining 3 years, the amount that you the lessee not pay yet, and of course the last amount that the lessee need to pay. So just add that for 45,563 and 4,250, you will get this amount. And this is actually the amount, this is actually the amount of 60,000 at the last year, something like that, in the future. future value of 60,000, the total of all this. So yes, this is happens in the future. The amount will be lower year by year. Okay, so we need to add with the first payment in advance, which is 18,000, and this is our ROU, 67,813, and we need to add the unguaranteed residual at the end of 4 years, which is 2,834. You will get this amount. And in order to know either you're doing it right or not, you can add fair value with incidental cost 68,000 plus 2,647. You will get the same amounts, which is 70,647. So we need to find the depreciation. Here is the formula: cost minus guarantee scrap over year. So we want to let's say want to list this item for 4 years, so we need to divide by 4, and we take the cost of ROU. So ROU minus with the cost minus with guaranteed scrap, which is 6,000, and then we need to divide by 4. We will get 15,453 per year. So here is the table of the lease payment schedule for B Limited. Okay, so I think I will show all of this. Okay, so this one is actually like this. Okay, in year X4 you already pay 18,000, so you don't need to write anything here, and there will be no interest charge and no liability. So but this is the liability, actually the lease liability that we have counted before. Okay, so next year you need to B Limited need to pay 18,000, and this interest expenses is actually 9% of this. You need to times with this amount, 49,813. You will get this amount. Okay, because this when you actually have loan with someone else, you need to pay the interest expenses. So this is same, almost actually the same concept. Okay, so we need to minus 18,000 minus with interest expenses. Okay, minus with interest expenses, we the liability will reduce, and it will become 13,517. So this amount, which is 49,813, need to minus with the liability reduction, and this is the balance. The same things happens until you get 0. Okay, so move on to the next slide. Okay, let's prepare the journal entry. So first of all, in 2000 X4, we need to debit ROU and credit this liability and credit cash, because the cash has been gone out for the first advance in payment for the lease payment, and we have another 49,813 for as our lease liability. Okay, and after that we have we need to treat the executory cost like this, because it's not included with the leases, it's not related with the leases. So debit prepaid executory cost 1,800 and credit cash 1,800. Okay, so moving on to the next year. So at the beginning of the year, we need to do the reversal of executory cost prepayment. Okay, so debit executory cost prepayment and credit prepaid executory cost, which is the amount of 1,800 will be prepaid, will be no more, So it's already deducted at the beginning of the year. So at the end of this year, there will be interest expenses. Okay, so we can see it. We can see here 4,483. This amount we take from here. Okay, all the interest expenses we just take from here, and we need to pay lease payment $10,000 per month. Per year. Okay, so here we can see interest expenses debit and lease liability credit. This is to charge the interest. We got lease liability 18,000. Also we pay it with cash. So this is to pay the to do the payment for leases. Okay, and here we need to do same things to do the payment of the executory cost prepayment. And don't forget to include the depreciation, debit depreciation, credit, accumulated depreciation with this amount. Okay, so basically we actually do the same things for the next year, 2000X5, but with different interest expenses. Okay, so we do the same things. Interest expense, we start here. So 1 July 2005, executory cost prepayment 1,800 debit, and prepaid executory cost 1,800 credit. So we got at the end of the year, it will be BLTD will be charged interest at 3,267, and then they will pay at this amount. Okay, debit less liability, credit cash, and then also they do the same things, prepay executory costs and credit the cash, and include the depreciation expenses also. Okay, so this is the third year. They will pay the same things, and you can see here the interest expenses is lower than before, 1,941. So we do the same things, and I just keep this. And okay, this is the end of the lease term. Okay, so at the beginning of this one, 1 July 2007, the beginning of the year, we do the reversal of executory costs. Okay, reversal of the prepayment 1,800, and then after that we do at the end of the year, we can see that the interest expenses is $496, and then we can see here lease debit lease liability for 6,000 because we pay 6,000 only, not 18,000. This is the last year. And credit cash. Okay, credit cash. Okay, depreciation here. So actually depreciation is equal, just round off this one. Basically I just round off become 15454, because actually it has a decimal place. So this is to charge the depreciation. And the difference here between this year and previous year, you can see that we don't need to do prepayment. Okay, prepaid executory cost, we don't need to do that because this is the last year of the lease term. Okay, and so that's not applicable here. And lastly, we need to do accumulated depreciation. We need to add all the depreciation for 4 years, and then we need to return the vehicle to the lessor with this amount. Okay, so that's all from me. Thank you very much.
I'm Naja here, so I will continue with accounting for lessor financing lease. So what is a lessor? A lessor is someone who grant a lease to someone else. As such, A lessor is the owner of an asset that is leased under an agreement to a lessee. In a lease agreement, the lessor is defined as the person that receives payment in exchange for the usage of its asset or property. The lessee is the person that pays the lessor for the use of the asset or property. So, what the difference between lessee and lessor? So, for example, consider a rented apartment. The tenant is the lessee and the landlord is the lessor. The lessee pay rent to the landlord and the lessor receive payment from the tenant. Second one, the lessee pay the lessor for the right to use the asset or property, and the lessor receive payment from the lessee in exchange for the usage of the asset or property. So we need classify the lease first. Are risk and reward of ownership transferred to lessee or not? So if yes, then the lease is finance lease. And if no, then the lease is operating lease. So what is finance lease? First, lease in which the lessee full control and ownership of the asset. Second is responsible for all maintenance and other costs with the asset. Next, the lessee assume both risk and benefit of the ownership of the asset. And the last one, a finance lease is a long-term lease that spans most of the asset's useful life. So this is the situation that lead to finance lease. First, ownership transferred to the lessee by the end of lease term. Second, an option for the lessee to purchase the underlying asset at price that lower than its fair value. Third, the lease term is majority of economic life, and the present value of minimum lease payment represent all of the asset fair value. And the last one, lease asset is specialized in nature.
Hi, I'm Kisha. I will talk about recognition and measurement of financing lease by lessor. So, in the case of financing lease, the lessor shall recognize the amount due from the lessee as a receivable or debtor, and do not capitalize the leased asset as a property, plant, and equipment. If the lessor had previously recognized the property, plant, and equipment before the lease, then he should de-recognize it. So, since the lessor provide the financing to the leased asset, uh, it should recognize the interest income for that financing. So the lease receivable here is the net investment in the lease, and the net investment in the lease is the total of fixed payments, variable payments, residual value guarantees, exercise price of purchase option, penalties for terminating. All of these items are in fact payments not paid at the commencement date, and they should be discounted and plus with the initial direct cost. We will see what is initial direct cost in the next slide, and the creditor will be the property, plant, and the equipment. The MFRS 117 requires that lessor shall recognize assets held under a finance lease in their statement of financial position and present them as a receivable at amount equal to the net investment in the lease. Net investment in the lease is equal to gross investment in the lease minus unearned finance income. To find the net investment in the lease, this is the formula. And to find the gross investment, this is the formula. Which is gross investment equals to aggregate of the minimum lease payment plus unguaranteed residual value. This should have to be discounted by the interest rate implicit in the lease. To find this lease payment, minimum lease payment, this is the formula: lease rental or payment plus any guaranteed residual value. To find unearned finance income, uh, this is the formula for unearned finance income equals to gross investment in the lease and its present value. Okay, as I said in the previous slide, initial direct costs must be added in the lease receivable. So let's see what is initial direct cost. Initial direct costs are incremental costs that are directly attributable to negotiating and arranging a lease. So these are the examples of initial direct costs: commissions, agency and legal fees, and other directly attributable costs that incurred by lessor in negotiating and arranging a lease. So MFRS 117 requires that for finance leases other than those involving manufacturer or dealer lessors, the initial direct cost shall be included in the initial measurement of the lease receivable. So subsequent measurement is quite simple. You need to only focus on lease receivable. So we have to split lease payments between reduction of finance lease receivable and finance income. So we have to debit cash and credit lease receivable, while the interest income will be the profit in P&L. Okay, let's see what is financing lease by manufacturer or dealer. It is quite different. There are two possible ways where the lessor as a financier or the lessor himself as a manufacturer or dealer. Lessor as a financier who provide the finance to purchase the asset from a manufacturer or dealer and leases it out to the lessee, also known as direct finance lease. While lessor as a manufacturer or dealer are normally offer customers a choice to either buy the asset for cash or by leasing arrangement, also known as sales type leases. So in the leases book, it doesn't matter whether the lease is direct finance lease or sales type leases. But in the lessors book, there are some minor difference between the accounting for direct finance lease and accounting for sales type lease. So let's see how they allocate the income elements. Allocating the income elements is a finance lease of an asset by a manufacturer or dealer gives rise to two types of income, which is the normal gross profit on sale and the finance income over the lease term, where the gross profit equals sales revenue minus cost of the asset, and the finance income equals gross lease payment minus fair value of the asset. So, artificially low interest rate is quoted. It is sometimes manufacturer or dealer lessor charge artificially low interest rate for the financing of leased assets. The effect of this requirement is that the effective income is maintained at the market rate, while the gross profit on the sale is reduced for the decrease in the total profit due to the artificially low rate of interest charge.
Hello everyone, I'm Deborah and I will be explaining the example of accounting for lessor in financing lease. Let's take a look at the question. So we will be referring to the same question Vicky referred us out, but Vicky talked about lessee. We will be talking about the lessor, which means we are the A limited. But there's an extension of the question. So this is the one, and let me read it. Assuming A limited classifies B limited as finance lease, A limited need to prepare a schedule of lease receipts. The amount recognized by the lessor includes the unguaranteed residual value. The calculation in example 1.6, the present value is shown to be 2834. Since they have mentioned that the amount recognized by the lessor includes the unguaranteed residual value, which is the calculation that Wiki showed us now, which it is this unguaranteed residual value. So since we have this, so we will be adding this 2834 to 2834 to get our full amount receivables. Okay, so this is our lease receipts schedule. So there are a few explanations that I've given here. So the explanation I've given here, the first one is this balance. Okay, this one. How do we get this interest revenue is that we times this balance in receivables with 9%. Why? Because that is what is given in the question, the 9% for interest rate. In this one, how do we get 52,647 is we minus our this amount that's now this 70,000 with 18,000 the advance payment. The advance payment that is made on year X fall. So we minus that with so we minus this and we got this figure. Okay, and for this one, why it is 10,000 and not 18,000 just like others is because of the question also. That's now Vicky's question. This it is said that its estimated residual value at the end of lease term is 10,000. So I'm sorry. So it's 10,000 here and not 18,000. And to make sure that we got the correct calculation, this one minus with this one, we have to get the same amount as the balance in receivables. So this is to make sure that we get correct calculations. Okay. And let's move into the question, which is to do the journal entries. Okay, on 30th X4, 30th of June X4, these are the basic things that we have to do in journal entries, because this is like the start. So buying a motor vehicle, buying it in cash. Why it's cash? Because they didn't mention if they use cash or bank in the question. So we just simply we just put cash. Okay. So a motor vehicle and then a cash. So this is the note purchase of motor vehicle. And then for this is we got the money, the lease receivables. So we debit the lease receivables and we credit the motor vehicle with the note lease of motor vehicle. This one on lease receivables, it says payment of initial direct cost. Where does this leads us is in the question itself, where is here in $2,647. This is the amount that is used as initial direct cost. So here, that is why we have this amount. That's why we debit lease receivables and then cash here with a note payment of initial direct cost. And then we have this, the 4th entry here. This 19,800 is from the question as well. It is the lease receivable amount. And then we credit 18,000 as the lease receivable amount, because as I mentioned just now, it's the advance payment. It doesn't include any interest, but it's just the one lump sum advance payment. And then reimbursement in advance. What is this? Is this reimbursement is done to protect the lessor by decreasing the lessor's credit exposure. So this is done with the first lease payment. And to explain or to make you understand more, we have to move to the second or 20x5's explanation here. If you can see here, we have reimbursement in advance. We debited this. This is actually a reversal accrual payment. This entry is to support this 1,800. It's a reversal accrual payment. And then we have insurance and maintenance expense. It should be done in annual basis. It's from the question as well, 1,800. And this one is the lease receivable payment. So the cash is 19,800. And the lease receivable, this amount and this amount, where do we get it from? It's from the table that we calculated just now. It's the schedule in lease receipts. So if you can see, there's this reimbursement as well. This is the receipt for second lease payment. Okay, then this is for the third lease payment. It's the exact same thing for the year X6, but the different thing is the lease receivable amount and the interest revenue amount. It's different because the balance interest receivable will be different every year. This is for the third lease payment. And then this is for the fourth lease payment. It's the same thing except for the lease receivable and interest revenue. And the final one, we have this. For this, we don't have $18,000, but we have $10,000 because it is the final year. We have to say bye-bye to the vehicle. So it's 10,000 and we don't have any reimbursement.
A very good morning to my lecturer and my fellow friends. My name is Nur Alia Amira, and today I'm going to talk about the accounting by lessor for operating lease. Okay, so there are two classifications of leases, which are finance lease and operating lease. The classification of leases as operating leases was carried forward from IAS 17, and therefore I won't go into detail here. So now I'm going to talk in general about operating lease. The accounting for an operating lease assumes that the lessor owns the lease asset, while the lessee has obtained the use of the underlying asset only for a fixed period of time. In addition, operating lease is a lease that does not transfer substantially all the risks and rewards from ownership of an asset. Like risks include the possibilities of loss from idle capacity or technological obsolescence and of variations in return because of changing economic conditions. And then for rewards, it may be presented by the expectation of profitable operation over the asset's economic life and gain from appreciation in value or realization of a residual value. So now, when a lease is classified as operating lease, the underlying asset stays in the statement of financial position of the lessor and is presented according in nature. Okay, so for my part, I will cover about recognition and measurement under the lessor perspective. Okay, the first one is lease payments. Under lease payments, it will be recognized in profit or loss over the term of the lease on a straight line basis, unless another systematic and rational basis more clearly represents the benefit that the lessee is deriving from the underlying asset. Furthermore, profits cannot be recognized at the beginning of an operating lease, since control of the underlying asset has not been transferred to the lessee. Secondly, is variable lease payments. The record in profit or loss in the same reporting period as the events that triggered the payments. And then we have initial direct costs. Okay, under initial direct costs, this will recognize initial direct costs as an expense over the term of the lease, using the same recognition basis that was used for the recognition of lease income. Okay, so moving forward, the lessor also should recognize lease payments from operating lease as lease or rent income on a straight line basis over the lease term, as I mentioned before on the previous slide. And then any lease bonus is recognized as unearned lease income to be amortized over the lease term. And then initial direct costs incurred by the lessor shall be capitalized as cost of the leased asset and recognized as expense over the lease term on the same basis as the lease income. Okay, for this one, executory or ownership costs are recognized as expense too. And then depreciation of the depreciable asset shall be consistent with the lessor's depreciation policy, and any refundable security deposit shall be accounted for as liability by the lessor. And then if the collectability of the lease payments and payments related to a residual value guarantee are not probable as of the commencement date, the lessor limits the recognition of lease income to the lessor of the payments described in the immediately preceding bullet points or the actual lease payments. These include the variable lease payments that have been received. And then, for example, if this assessment later changes, any difference between the income that should have been recognized and which had been recognized is recognized in the current period. Okay, so I will pass to my team member, which is Zakwan, for the further explanation about the measurement for the perspective of lessor, and further example to my team partner, which is Shafiq. Thank you.
Alright, thank you to Alia for her presentation just now. A very good morning to Madam Shokirin and my fellow friends. So, moving on to my part, I will cover the measurement of operating lease by lessor under the subleasing. Actually, there are two types of methods that can be used to measure. The simplest one is by using straight line basis method, which will be covered by Shafiq later. And the other one is the right of use asset, which is more complex when applied by a lessor in a sublease arrangement. So what is sublease? Sublease is a transaction whereby a lessee leases an asset from a lessor, and the lessee then releases the same asset to another third party as a lessee. You guys can see, or you guys can refer to the graphic that I have prepared. Okay, here is the example that I have provided. The scenario is when an intermediate lessor enters into a 5-year lease for 5,000 square meters of office space with the head lessor. So we will be looking into the facts pattern of subleases. At the commencement of the head lease, the intermediate lessor subleases the 5,000 square meter of office space for 2 years to a sublease. So the classification of subleases we call it as an operating lease. The operating lease, the sublease is for 2 years. The right of use asset arising from the head lease has a useful life of 5 years. The intermediate lessor concludes that the sublease is an operating lease because none of the indicators for a finite lease in IFRS 16. The accounting for sublease. When the intermediate lessor enters into the sublease, it retains the lease liability and the right of use asset relating to the head lease in its statement of financial position. But during the term of the sublease, the intermediate lessor can recognize a depreciation charge for the right of use asset and interest on the lease liability. And it also can recognize the lease income from the sublease. Okay, we move on to the next slide. Okay, in this slide, I will explain about what is the definition of right of use asset. So the right of use asset is an asset representing lessee's right to use the lease asset during the lease term. The component of the right of use asset. Basically, the right of use asset is measured at the cost at the commencement date. The amount equal to the lease liability at its initial recognition. The lease payment made at or before the commencement of the lease has less any lease incentive received. The third point is any initial direct cost incurred by the lease and an estimate of cost to be incurred by the lessee in dismantling and removing the underlying asset, restoring the site on which it is located, or restoring the underlying asset to the condition where required by the term and condition of the lease. unless those costs are incurred to produce inventories. Alright, on this slide I will explain more about the example of initial measurement of the right of use asset and lease liability. Okay, the commencement date will be 20x1, 11. The discount rate will be 5%. Initial direct cost 20,000, lease incentive 5,000, upfront lease payment for year 20x1 will be 15,000. You guys can refer to the table that I have prepared beside. So the first column is payment, date of payment, discount factor, and discounted amount. For the payment will be the same on each every year, which is 15,000. The discount factor will be different in each year. And how to get discounted amount will be the payment times by discount factor. Example for the first one, for the first year, 15,000 times by 0.9524, and we will get 47,619. And the calculation will be the same as for the next year. And after we get all the years, will we add on the discounted amount for each year, and we will get the total amounted for 355,391. That total will be recognized as initial measurement of the lease liability. On this slide, we will calculate the total right of use asset. Okay, firstly, we take initial measurement of the lease liability, the one that we have calculated before, which is 355,391. And then we take initial direct cost, which is 20,000, lease incentive 5,000, upfront lease payment for year 20x1, which is 15,000. So how to calculate it? The first step is by adding the initial measurement of the lease liability and initial direct cost, and minus lease incentive and plus upfront lease payment for year 20x1. And then we can get the total right of use asset, which amounted to 420,391. So that's all for my part, and I will pass to Shafiq to explain more about straight line basis method. Thank you.
I am Shafiq Faiz, and my part is on the examples of operating leases regarding to the accounting for lessor. So actually, for example one, this is just a simple question to know or to test you whether you can differentiate between the operating lease or finance lease, as the keyword here for this question is about the ownership. So for the example one, on 1 January 2000 X1, an entity entered as lessee into a 5-year non-cancellable lease of farmland with a fair value or cash cost of 100,000 ringgit. So the lessee is required to pay the lessor for 5,000 ringgit per year. So the question here is that they ask us whether this question, is it an operating lease or not? So the answer is yes. Why? Because the lease does not transfer substantially all the risks and rewards incidental to ownership from the lessor to the lessee. As for example, we have gains and losses in the fair value of the farmland accrued to the lessor before and after entering into the lease agreement. So the lessee merely has the temporary right of use of the farmland for a small part. For instance, here we have 5 years of the indefinite economic life of the farmland. The next question on example 2. All of you should know that if we have an operating lease, there is any lease which is not a finance lease, and for it to be that operating lease, we still have the risk and reward, as they have not been transferred to the lessee, and we know that the lessor still has the risks and rewards of the ownership. So for the example 2, question is Samsung Tech leases out a machine to Sandbox Company under a 4-year operating lease. The terms of the lease are that the annual lease rentals are 2,000 ringgit payable in arrears. As an incentive, Samsung Tech grants Sandbox Company a rent-free period in the first year. So explain how Samsung Tech will account for the lease in the financial statements. Based on what you have got from the question is, you need to go through and look at the rental income per annum and be careful as there are only three payments to be included in the first year as they got a free rent from Samsung Tech. This is the calculation to find the rental income per annum, 3 years times 2000 divided by 4 years and then we got 1500 per annum. So it will be included in the statement of profit and loss. So this is the journal entry for the first year. Debit accrued income 1500 and credit rental income 1500. As for the first year, we have released the asset out rent free, so we don't have any cash. This it gives us a bit of an issue. However, we can debit accrued income and credit our rental income. So if you ask me why debit accrued income, it is because you own that money and you will receive that money over the final 3 years. It will be the journal entry for the year 2 until year 4. It will be all the same as there will be no such issue as compared to the year 1 regarding to the free rent. So we will debit bank 2000 ringgit and credit rental income 1500 ringgit and accrued income for 500 ringgit. This is how we will present it in the statement of financial position and statement of profit or loss. So for the first year, 1500 will be recognized as accrued income in the statement of financial position and 1500 will be recognized as rental income in the profit or loss statement. So for the second year, 1000 ringgit will be recognized as accrued income in the statement of financial position and 1500 ringgit will be present as rental income in the statement of profit or loss. Perhaps for the third year, we have 500 ringgit to be present as accrued income in the statement of financial position and 1500 ringgit will be present as rental income in the profit or loss statement. So for the last or final year, we will have zero balance for the accrued income. So there will be nothing to be recognized under the accrued income in the statement of financial position. But for the rental income, we still have to recognize 1500 under the statement of profit or loss. So the next example is quite similar to the previous example on example 1. But in this case, we have list regarding motor vehicle. But before this, we have list regarding farmland. So on 1 January 2000X1, an entity entered as lessee into a 5-day non-cancelable lease of a motor vehicle that has an economic life of 5 years and nil residual value. On 1 January 2000X1, the inception of the lease, the fair value or cash cost of the motor vehicle is 100,000. So the lessor charged the lessee 120 ringgit per day for the use of the motor vehicle. So at the end of the lease term, the lessee returns the motor vehicle to the lessor. So the question is there any is the statement given above referring to an operating lease? Perhaps to answer this question, you don't need to be scared or confused when you look at the figures or numbers. You just need to find the clues or key points as in this question, it is given on the last line of the sentence. At the end of the lease term, the lessee returns the motor vehicle to the lessor. As it is just a 5 days lease, so there will be no change in the ownership except if there is a statement in the question that states there is a change in ownership, then it will be certainly be a finance lease. But now, in this case, it is just a normal operating lease. So this is how you need to answer this question. The arrangement is an operating lease. Yes. Why? Because the lease does not transfer substantially all the risks and rewards incidental to the ownership from the lessor to the lessee. The lessee merely obtains the right to use the lessor's motor vehicle for only 5 days. Okay, for the next question, it seems complicated compared to the previous questions, but I will try to simplify it to make it clear. Hence, on 1st January 2000X1, an entity entered as lessor into a 5-year non-cancellable operating lease of a building. It completed constructing earlier that day at a cost of 800,000 ringgit. The building has an economic life of 60 years and nil residual value. The entity accounts for the building as property, plant and equipment using the cost model because the fair value of the property cannot be determined reliably without undue cost or effort on an ongoing basis. No lease amount is payable for the first 4 years of the lease. The single lease payment of 150,000 is due on 1 January 2000X5. So the question here asks us to give accounting treatment regarding to the statement given based on IFRS 16 operating lease. Hence, they had given some figure on the question, which on the first paragraph, we need to find the depreciation of the building. That's why they give us the cost of the building, which is RM 800,000 and also 60 years of economic life and zero residual value. Then, for the second paragraph, they had give us the details referring to the leases of the building. And we need to be careful as there is no lease amount for payable on the first 4 years of the lease. Hence, they will only receive the total payment on 1 January 2000X5. So, to answer this question, first and foremost, we need to recognize the operating lease as 30,000 ringgit as income in profit and loss statement for each of the lease term. If you ask me, why RM 30,000 ringgit? Because only on the 5th year they will get their lease payment. So 150,000 ringgit will be the total lease payment divided by 5, the total number of years being given in the question. And then you will get 30,000 ringgit for the income per year. So by 1 January 2000X5, the lessor would have accrued 120,000 lease receivable as a current asset. So how do I get 120,000? It is from the accrued lease payment from the previous year, which is 30,000 from 20X1, 30,000 from 20X2, 30,000 from 20X3, and 30,000 from 20X4. And this is how the journal entry should be recorded. For 1 January 2000X5, debit cash 150,000 ringgit and credit operating lease receivable 120,000 ringgit and also credit lease income received in advance 30,000 ringgit. Then for the next step, we should calculate the depreciation of the property on 1 January 2000X5 as the figures were being given in the first paragraph. So, to recognize the payment received from the lessee on 1 January 2000X5, the property is depreciated on the straight line method to a near residual value. So, 800,000 is the cost of the property divided by 60 years, the economic life of the property, and you will get 13,333 per year. Then, the depreciation is recognized as an expense in statement of profit or loss.
Hi everyone, good morning. My name is Azika. First of all, I wanted to say sorry because I cannot show my face while I'm presenting. My condition right now is really not letting me to show my face to everyone. So I hope madam don't mind if I presenting like this. Okay, I will proceed with my presentation. So this morning, I will talk about sale and leaseback transactions, and my partner Vishnu will elaborate more about the example. Okay, So what is sale and leaseback transaction is? Sale and leaseback transactions, or SALT, is actually a transaction when an entity or a seller sells an asset to another entity or a buyer, and then the buyer leases back the asset to the seller. Okay, for example, Mr. A seller, sells a house to Miss B, and then Miss B rent the house back to Mr. A. So from that transactions, Mr. A will receive a liquid funds from Miss B, and then keep it rights to use the asset sold through the leaseback side of the contract. Sorry. Normally, the fair value of the asset or the house is greater than its book's value. So when entering into sale and leaseback transactions, it can result in an accounting profit being recognized. So next, the accounting for sale and leaseback transactions under IFRS 16 is different to the IAS 17. The sale and leaseback transactions under IAS 17 is a lease differs the gain on the sale side of the transaction if the resulting leaseback is classified as a finance lease, not an operating lease. But if the resulting of leaseback is classified as an operating lease, the gain could be recognized in full if the proceeds of the sales side of the transactions equal to the fair value of the assets. Okay, next, the determination of accounting treatment under IFRS 16 is the sale must be assessed as whether it classifies as a sale in accordance with the requirements of IFRS 15 or not. Alright, the transfer to the buyer will qualify as a sale if first the seller de-recognize underlying asset and apply a lessee accounting requirements, measuring the right of use asset as the retained portion of the previous carrying value, and the seller recognize gain or loss on the rights of the transfer to the lessor. And second one, the transfer to the buyer will qualify as a sale if the buyer itself apply an applicable IFRS to the asset purchase and the lessor accounting requirement to the lease contract. So next, the transfer to the buyer does not qualify as a sale if the seller continue recognition the asset and the amounts received or recognized under financial liability under IFRS 9. Same goes to the buyer. The transfer to the buyer does not qualify as a sale. Does not qualify as a sale if the asset purchase is not recognized, and also the amount paid are recognized under IFRS 9 financial instruments under financial asset. If the sale side of the transaction does not qualify as sale under IFRS 15, it will be treated similarly as IAS 17, which is it is necessary to consider whether the sale price as stated in the contract is same or equal to the asset's fair value. Under sale and leaseback transactions IFRS 16, the requirements perspective from the lessee and the lessors need to be determined by reference to the fair value of the asset and not stated the contractual sale price. So this lessee perspective can be the profit or loss on the sale side, and the lessor's perspective can be the initial measurement of the asset purchase. As a result, lessees or sellers need to determine the fair value of the asset in order to ensure they recognize the correct profit or loss on the sale. And same goes to the buyer or lessors, which this is for the purpose of accounting for the cost of the asset rather than they assuming the asset's fair value, which will be equals to the stated contractual sales price. If it is determined that the fair value of the asset is less than or greater than the contractual sales price, the difference is accounted by the lessee as additional borrowing or prepayment. Same goes to the lessor accounts. If the leaseback is classified as an operating lease, the lessor accounts for the difference will be rents receivable or deferred rental income. And if the leaseback is classified as a finance lease, the adjustment will be the adjustment to the finance lease receivable. In some cases, it may be easier to compare the contractual leaseback rentals to the market rentals rather than the contractual sales price to the fair value of the lease asset, in which case the standard also permits the approach when determining whether both sides of the sale and leaseback transactions are at open market rates. The calculation of the lessee profit or loss on disposal need to be remembered that a lessee or a seller does not transfer control of the whole asset to the buyer, because it will continue to control the same asset during the leaseback period. So I will pass to my partner Vishnu to elaborate more and give more explanation about the example. Thank you.
Let's look at the example. Example 1. Sales and leaseback transaction where transfer is a lessee. What is lease? What is leaser? And what is lessee? So lease is where you rent your property or your land to another person. The person who rents his property is called a leaser, and the person who rents a property from another person is called a lessee. So here in the example, a sale lease enters into a sale and leaseback transaction whereby it sells a property to a buyer leaser for Cu 2 million. Simultaneously, the seller leases the property back from the buyer leaser for a period of 18 years with annual lease payments at the end of the year of Cu 120,000. The sale meets the criteria of IFRS 15 to be accounted for as a sale. There are no initial direct costs in the transaction, and before the transaction occurs, the property has a carrying value of Cu 1 million. The fair value of the property at the time of sale is Cu 1,800,000. Since the consideration does not equal to fair value, adjustment must be made to determine any gain or loss arising by reference to the asset's fair value. The excess consideration of Cu 200,000. Okay, we got the Cu 200,000 by subtracting Cu 1,800,000 from Cu 2 million. Is therefore accounted for as additional financing provided by the buyer leaser to the seller lease, not consideration on the sales sides of the transaction. The discount rate is 4.5% per annum, determined by reference to the seller lessee incremental borrowing rate, as the rate inherent in the lease is not readily determinable. The present value of the annual lease payments, 18 payments of Cu 120,000, 4.5% discount per annum is Cu 1,459,200,000. This transaction is as follows. See corresponding notes reconciling each component of the theory. Okay, we are going to debit cash CU 2 million, then debit right of use asset CU 699,555, and we are going to credit PPE, the property sold, with the value of CU 1 million, and lease liability with value of CU 1,459,200, and lastly gain on rights transferred CU 240,355. All this will be credited, and CU 240,335 is the gain on sale, is the balancing entry in the transaction, but it can be also reconciled as follows: gain equals to proceeds attributable to the portion of the asset for which control is transferred less carrying value of the portion of the asset for which control is transferred, attributable to the portion of the asset being disposed. How do we find them? Firstly, the total proceeds less total amount of financing received. We have CU 2 million minus or subtract CU 1,459,200, and the balance is CU 540,800. Secondly, carrying value of the portion of the asset being sold. How do we find this? Carrying value less right of use asset retained. So here we have CU 1 million minus or subtract CU 699,555, and we have CU 300,445. Therefore, the gain on disposable would be CU 540,800 minus CU 300,445, and we'll have CU 240,335. Now, let's look at another example: sales and leaseback transaction with variable payments. Okay, the example previously that we have seen illustrates how IFRS 16's requirements should be applied in circumstances where the lease payments in the SALT are fixed. However, applying the requirements becomes more complex when the underlying lease has variable payments that are not dependent on an index or rate. For example, assume a seller lease enters into a SALT for one of its buildings with the following characteristics: carrying value of the building immediately before the SALT of CU 2 million, fair value of the building is CU 5 million, sales price for the building is CU 5 million, the resulting lease has no fixed payments. Lease payments are based on a percentage of sales revenue that will arise from the business activities that will be conducted in the building. And the remaining useful life of the building is 20 years, and the lease term is also 20 years. In this example, the lease payments as defined by IFRS 16 are 0. Since there are no fixed payments, they are all variable lease payments not dependent on an index or rate. Applying this formula to this pattern, rights detained equals to discounted lease payments over fair value of the underlying asset. The discounted lease payments are nil, over the fair value of the underlying asset, which has a value of 5 million, and the rights retained is equals to nil, 0. This is a very simple calculation of maths. If rights retained are nil, then the differences between the cash received, which is CU 5 million, and the derecognition of the building CU 2 million would be accounted for as a gain of CU 3 million. In our view, this outcome is not consistent with the requirements in IFRS 16 100A, since the calculation of the gain is meant to represent the rights transferred to the buyer-leaser. In this fact pattern, the entire remaining useful life of the building which is 20 years, will be used by the lease since the lease term is also defined as 20 years.
Alright, hi. So basically for my part, I'll be presenting on the presentation and disclosure of leases under IFRS 16, which the presentation is very for lessee and lessor. Alright, as lessee, the lease is accounted under IFRS 16, which in the result, the recognition is being divided into two, as for right use of asset and also lease liability. Okay, usually lease liability is being recognized as interest expense, but right use of asset is being recognized as depreciation expenses. Okay, so basically these two elements is being recognized and presented separately because it is a two different thing, but there is some consequences that company want to merge the recognition, which means company want to combine the combination of these two, right? And so to be able to combine recognition of these two element, right, these two element in statement, company need to acquire the lease liability, which means the company need to buy the asset, the asset leased by the company. And so both could be presented in the same line in statement, and usually it is a property, plant, equipment. Okay, at the end, if company acquired the asset, they could be recognized as one line item. Okay, but it is exceptional for non-lease asset and liabilities, because usually it been recognized as investment property, because it is an investment property right of use. We cannot recognize it as a right use of asset. We cannot depreciate the non-lease asset, and because of that. However, for lessees, the requirement usually based on IAS 17, which different compared to lessee, and it also been divided into two. It could be a finance lease, and it could be an operating lease. Usually, finance lease is being recognized as receivable, but operating lease is an asset. It's an asset by nature. Okay, but depends. It could be a building or a machine. Okay, a building will appreciate, but an asset, it could not be appreciated. So basically, it depends on the nature of the asset itself. Okay, and so moving on to our next slide, this is a consolidated statement of financial statement, alright, which as you can see here, on the left side here, there is an IFRS and what's not, right? This is the details of the elements in this statement, alright. So as you can see, there is an investment property and finance lease receivable under non-current asset, and finance lease receivable under current asset. And the placement of lease liability could be under non-current and current asset. So this is an example of placement of the elements under statement, which could be a good example if you want to have a look on, alright. To make a reference. Okay, so this is an example of placement. And moving on into our second slide, our next slide, I mean. Okay, so basically this is our profit and loss statement. Alright, and so as you can see here, this change in fair value of investment property. Okay, this could be a non-lease asset. Okay, this is a non-lease asset. Alright, so basically it could be investment property which we cannot depreciate. Okay, and the next information is depreciation, which it could be our right use of asset. Okay, at the end we'll get operating profit and comprehensive income. Okay, and so this is our profit before tax after we minus out the finance cost. Okay, and then moving on into our consolidated statement of changes equity. So basically, this is example of placement of leases. Like for instance, as you can see, there's an adjustment, right? It could be a company maybe lease a building in the middle of a year, and so company need to make an adjustment based on adoption of IFRS 16, and so the company need to adjust in the statement of change of equity. And so because of that, the placement of this adoption need to be adjusted. Okay, and moving on to the next slide. Alright, so basically this is detail on presentation of both financing activities and operating activities in the cash flow statement.
Alright, as financing activities is an amount relating to the repayment of the principal portion of the lease liability, while for operating activities is an amount relating to short-term and long-value asset leases that are accounted for balance sheet for variable payment not included in the lease liability. Alright, so basically, usually this is a repayment of a principal, and this is maybe small amount that is not related to big asset and did not mention in the statement of balance sheet, but still material to the company. Okay, and interest paid on other form of financing for amount relating to interest charge on the lease liability. Okay, and this is example of how to present the information as mentioned just now. Alright, so this is operating activities, and non-cash adjustment. So basically repayment of borrowing. Okay, so mention here about repayment of borrowing and leasing liability, which related to our leases and interest. Just IFRS 16, repayment of borrowing and leases liability. Okay, and in terms of disclosure, in describing disclosure, usually just the same as what stated in other IFRS also. So basically, they need to provide users of the financial statement with a basis access to the effect of leasing activity. So basically, they need to inform the member of the company on any cases related to leases, which may be material. Maybe it's not being mentioned in the statement, but we need to disclose in notes so that we aware, we make an awareness to the user of this statement on anything related to leases, and lessee and lessor need to disclose both qualitative and quantitative information. And for lessees, the information is required to be presented in a single note and need not to be repeated as long as it is appropriately cross-referenced. Alright, I think that's it from me. That's it from our team on the presentation on leases of IFRS 16. Okay, thank you.